Welcome everybody to the Mortgage Workshop Road to Home Ownership. We'll be discussing a lot of great items tonight for first-time home buyers. But before we do that, let me introduce our IH Mortgage team. My name is Kurt Johnston. I am the Vice President of Mortgage here at IH. I've been here for about 16 years. I'm located here at the headquarters. We have Jamie Allison. Jamie is in our Milan branch. Tasha Bunker, she'll be speaking here a little bit later. She's here also at headquarters. Sherry Herrick. Sherry is at our Milan or Moline on the Avenue branch. Brooke Victor. Brooke Victor's here at the IH corporate office also. Courtney Contreras. Courtney will be at our East Kimberly branch. And then lastly is Tyler Conrady. He's a mortgage loan assistant here at our office here at the headquarters. Our presenters tonight will be myself, and then we have Rachel Criddle, that will be talking about credit. Tasha Bunker will be going over some down payment assistance programs. We have James Jones from the city of Rock Island, and then we have KJ Whitley from the city of Moline going over a lot of the different programs that they have and how you can get some good money for your down payments with those. Quick agenda, we'll be talking about home buying, the different mortgage options that you can look at, your credit, how to protect your credit, what goes into credit, if your credit's not where it needs to be, how you can improve it, down payment assistance programs, how can you get money to help you with your closing costs and down payment, and then lastly the path to closing from all the way at the beginning to the closing, even after closing, so you can understand that. Going through some different terminology, things you should know, you might know already, or things you might be learning in this process. So let's get started. First, we're going to talk about benefits of owning a home. First of all is tax deduction. You're paying interest, you pay your homeowner's taxes. You can write those off most of the time. Once again, I am not a tax advisor. The taxes and the interest that you pay on your mortgage, you a lot of times can write that off, get with your tax advisor to make sure. Amortization, you own your home. With each payment that you make, your balance works down more. The way it's set up is you pay most of the interest, a lot of interest up front, but with each payment you're paying more principal. And you'll see that with every payment. So your balance is working down quickly. And then appreciation. This is not an auto loan. If you drive your auto loan off the lot, it depreciates $5,000 right there. This is a home, and most of the time your home appreciates. So as you pay down your loan, your home is actually appreciating most of the time. So you're getting that nice balance of equity that you're building up. And then personalization. This is your house. You're not renting it. If you want to paint a room red, you don't have to ask a landlord if you have to do that. If you want to knock out a wall to make a room bigger, make sure it's not a load-bearing wall, but you can do that. And then lastly, assets. This is, for most people, the largest asset they'll have, a 401k or their home. So it's an asset that you're building equity in as you pay on it. Now, those are the fun facts. Here's the things to consider while you're buying a house. You're going to probably have to have some cash up front. We're going to talk about assistance programs, but you're going to have some skin in the game with this. So before you look to buy a house, you're going to have to do some savings. You're going to have increasing expenses. A lot of times, with your rent, that just includes your rent, but now you have your taxes, you have your insurances. There's going to be maintenances for the house that you're going to have to think about. And property fluctuation. Like I said, most of the time, the value of the house goes up, but we have seen years where it doesn't. So you're understanding that it won't always go up. So sometimes the house value can go down. It's more rare, but it can happen. And then limited flexibility. If you decide, listen, I hate these winters in Iowa and Illinois, I'm moving to Florida. That's awesome. Except you got a house now. You got to make sure that either you're going to sell the house or you find someone to make the payment for you, or you're going to have 2 payments before you move. And then repairs. You have a furnace. If it's 15 to 20 years old and you move in that house, that means it's kind of at the end of its shelf life. Same thing with the roof, the windows. So when you're looking at a house, that's one of the things you want to find out, or how old are these items? Is this something that I might have to replace a year down the road? Is this something that I can work in to my deal when I talk to them to negotiate that? I know for my first house, the roof was 20 years old, so before I bought it, I negotiated, paid a little bit more, but I got the roof redone. So those are the things to look at before you buy a house, and then also once you're in your house. For the next part of our presentation, we're going to be talking about credit fundamentals, and for that we have Rachel Criddle to talk about that.
Thank you, Kurt, for the introduction. As Kurt had mentioned, I'm Rachel Criddle. I'm one of the senior home equity specialists here at IH. And I have worked here for 25 years, so I have a lot of knowledge and background and experience with the credit union. So I want to talk a little bit about credit fundamentals, which involves understanding key concepts like your credit score, credit reports, your credit worthiness, how responsible you are, which builds a strong financial foundation. So the first thing I want to just briefly mention, we've all heard the word credit report, which is a detailed record of your borrowing, which is maintained by our three major credit bureaus, which are TransUnion, Equifax, and Experian. Your credit score, which is a numerical representation of your credit worthiness, which is based on your payment history, your credit utilization, your age of credit, and a credit mix. Importance, a good credit score is crucial to obtaining favorable loan terms, credit cards, and other financial products. Monitoring your credit, so on a regular basis, checking your credit reports for accuracy to identify any errors on your credit report is huge. That's one thing you'll always want to try to monitor if you can, and I'll give you some ways that you can do that. So 35% of your credit score is made up just of on-time payment history, which is a huge chunk. So making payments on time is extremely important. Most financial institutions and credit companies have grace periods. So if you can take advantage of those grace periods and pay within those grace periods, that's going to help so that you avoid any late fees. But again, 35% is a huge number. Keeping your utilization low, that's really important too. Don't use too much available credit, as high utilization can negatively impact your score. Avoid over-indebtedness. Don't borrow more than you can afford. That's huge. Sometimes we want that extra credit card, or we want a loan to do something for some reason, but not taking on more than what you can is extremely important in helping build a strong credit foundation. 30% of your credit score is made up of amounts owed. So a general rule of thumb is try to keep about 50 to 70% available credit. So example of that would be if you have a $10,000 credit limit, you only want to have, or you want to make sure that you have between $5,000 and $7,000 available. That will really help your score. When I first established a credit card with IH many moons ago, the way that I was taught is use the card and then pay it off right away. So that will help build your score and show on-time positive payment history. Having a good mix of credit, like credit cards and installment loans and revolving credit is also good. So credit mix makes up 10% of your score, which means, again, personal loans, mortgage loans, credit cards, things like that having a good mix will make up a good score. The last 10% of your score is based on new credit. So opening up new trade lines. Research shows that opening several accounts in a short amount of time, that can adversely affect your credit score. You have a greater risk that way, so if you can avoid it, try not to open up too many accounts at one time. Having a lot of different lenders pull your credit too, that can hurt your score sometimes. So we want to make sure too that you're not out applying for a bunch of different credit cards and a bunch of different loans, because that could hurt your score. I mentioned earlier monitoring your credit, so stay informed. That way you can catch any errors. You can once a year go to annualcreditreport.com and get a free copy of your credit report. So the credit union, as a general rule for consumer loans, we use the TransUnion bureaus. The mortgage department will use all three bureaus and do what's called a tri-merge, and then they take the middle score. With TransUnion, a good number to shoot for us is generally around 700. Now, to get our best interest rates possible on the consumer side, you want to have a credit score of 730 or above. But that 700 is a good number to shoot for. Because it's going to help you potentially have better interest rates on loans, and then your ability to borrow with that higher credit score becomes greater. You want to know where you want your credit to be. These are just a couple of examples. So as a home equity specialist, I don't process first mortgages, I do second mortgages, which you will learn over time once you build equity in your property. But say that you have a house that's worth $100,000 and you owe $30,000 on it. At 100%, you now have $70,000 in equity. So once you establish that equity in your property, you can apply for a loan and use that equity to pay off credit cards, to consolidate debts. So a home equity loan eventually might be an option for you guys once you purchase. So if you're interested in improving your credit score, here are a few tips and tricks to follow. So payment history, make your payments on time, even if it's just the minimum. Try not to max out your credit cards. We mentioned avoid impulse buying on major purchases. If you're looking to buy a car, make sure you rate shop. Rates are important. That determines how much interest you're going to pay, obviously. Keep in mind if you co-sign for someone. If you co-sign for a child, a brother, or a sister, that can have sometimes adverse effects on your credit report because you're putting your credit on the line. So if they don't make the payment, you're going to be responsible, and then that will show negative credit history on your credit report, which could impact your ability to borrow later on. If what I just talked about applies to you and you're interested in improving your overall financial health, we're here to help. We do have 13 branches, our newest one being Des Moines. So there aren't financial coaches, which I'll speak to here in a second, at every branch, but they're the one-stop shop. The financial coaches at the branches where you're going to stop in. You'll be able to do financial checkup. They'll go over a soft pull on your credit report, so they're not even doing a hard pull at first, and they'll talk to you about budgets and to get you on the right path in order to be able to have a good foundation for good credit when you're ready to be able to borrow or buy a house. So make sure I have some business cards of one of our financial coaches that I'll pass out if anybody's interested, but that's really where you kind of want to start, is making sure that you know what your score is and what debts you need to pay down and where you need to be. And Kurt had even mentioned having money down. It's important to save too, right? I always inform members that these financial checkups don't often result in an immediate fix, so keep that in mind. It takes a lot of hard work. It's not an easy task. It takes a lot of time and dedication to stay on track to get your credit report and your score improved. We just ask that you put in that time and that dedication, and then we'll be here to help you along the way. Another great resource that IH offers is what's called Green Path Financial Wellness. It's a company we've been partnering with for as long as I can remember. They've been in business for over 60 years. What their options they have on their side, if you don't qualify for traditional financing right away, they can help you set up a plan and a budget, help you consolidate debts into one payment. So we tend to refer our members who don't qualify for traditional financing to Green Path to help put them on that right path to be able to borrow in the future. So I'm going to go ahead now and turn it back over to Kurt, but before I do that, we're going to watch a story about Deb and her journey to home buying.
I first met Deb back in September of 2020, and she came in looking for getting pre-approved for a house.
I decided that it was time to buy a house. I no longer wanted to rent. Well, there was a lot of things that I had to take care of, like my credit.
We went over everything, and what I noticed was there were some things on her credit that we needed to work on in order for her to buy a house. IH is partnered with Green Path, who will help our members improve their financial health in order to purchase a house, buy a car. They help with student loans. They help you improve your credit to where you can get out of debt.
They had the right tools to tell me on what to do, and I followed every tool, and then 39 houses later, I found my house.
So we got her pre-approved again, and we had talked about a grant called FHLB.
So being a first-time home buyer and being fortunate enough to get approved for that, it helped me be able to get in here and do all the construction that I'm doing now.
As a mortgage loan officer with IHMVCU, it gives me great pleasure to be able to help someone who, like Deb, has struggling credit and needs financial help on what they need to do.
Working with IH during this process was absolutely amazing. Sherry had the knowledge and the experience, and she was honest with me. Deb, this is what you need to do. So I trusted Sherry, and she guided me 100% correct. Like, she nailed it.
It's been really great to build this relationship that I have with Deb. We've gotten to know each other. We still are carrying our relationship that we built into both of our lives.
With the help of IH, I was able to get into this house, and I am so excited to make this my home.
That's a great story from Debbie. I actually know Debbie personally, and to see her come to us, probably a credit score maybe in the 480s, leave with a 700 and have a great house, that's an amazing story. You have to put in the work. If you're willing to put in the work, we can help you. So awesome story. And if you're not where you want to be right now with your credit, that's okay. We can help you, just like we did with Debbie. It's not going to happen overnight, but a part of that journey, we can get you where you need to be if you work with us. Okay, next I'm going to just go over some basic information. Some of you might know, some of you might not. To start off with, we're going to be talking about different mortgage types and what goes into them. So for instance, a fixed rate mortgage, what does that mean? It means your rate will never change. Your principal and interest amount that you pay will always be the same. So let's say it's $600 a month. It'll always be $600. Now within that $600, like I mentioned before, you'll pay more principal as you go down, but that amount will always stay the same. Your taxes and insurances can change. We'll talk about that later on in the presentation. The next is you have adjustable rate. You guys might have heard adjustable rate, or some people call them ARMs. People do offer those. ARMs, typically can increase or decrease after they go. To give you an example, we have a ARM, it's called a 5/1 ARM. And what does that mean? For the first 5 years, your rate's fixed. It cannot change. The 1 means after 5 years, once a year, your rate can go up or down during that time period. Most of the time it feels like it goes up, but there are times it can go down there, and that's part of an adjustable rate. If you know you're not going to be in a house as long, then maybe an ARM is better for you if you can get a lower rate. Really, the difference between fixed and an adjustable rate is what you're the most comfortable with. Myself, I've done 6 mortgages over the years, and I think I've done 3 ARMs and 3 fixed rates. So truly, it's what you're most comfortable with. You sit with the loan officer, and they'll help you walk you through to make sure that you feel comfortable with that. And you might hear people say next, conventional loans. What's a conventional loan? That's your normal fixed rate loan. You only have to put 5% down if you've already owned a home. If you're a first-time home buyer, on a lot of conventional loans, you only have to put 3% down. If you have less than 20% down, meaning your loan to value is going to be 80%, and to give you an example, when I say loan to value, it's your loan compared to the value of your house. To make this easy, let's say you buy a $100,000 house and you're putting 5% down, for $5,000 down, that means your loan to value is going to be 95%. So if you buy your house and you're above 80%, you're going to have mortgage insurance on that. We'll talk about that here later on in the presentation. Probably the biggest thing on the conventional loan is the minimum FICO score is 620. If you're below 620, you can still maybe get into conventional loan, but it's going to be a lot harder. If you're above 620, usually that's the minimum that we start with for conventional loans. The processing time is a little bit quicker. Usually a lot of conventional loans, they want you to have a lower loan to value or debt to income ratios. And what that means, debt to income, for example, is your debts that you have compared to the income that you make. So if you make $1,000 a month and you have $400 in payments, 400 into 1,000, your debt to income ratio is 40%. And that's usually what we like people to be at, 40, 43, below that when we're looking at a house. So those are your conventional loans. You might have heard of government loans. There's really 3 types of government loans that we offer. That's your FHA, your Federal Housing Administration, your VA, which is your Veterans Administration, and your USDA, which is the United States Department of Agriculture. So for your VA and USDA, a lot of reason why people would choose those is you don't have to put any money down, but you have to qualify for them. So a VA, obviously you have to be a veteran to qualify for a VA loan. For USDA loan, it has to be out in a rural area. You cannot do a USDA loan in the metro Quad Cities, but there's areas on the outskirts that you can. The loan officer would be able to help you out to see if you qualify or if those would be better than a conventional loan. And then FHA loans, A lot of people do that. Why would they choose an FHA loan versus conventional? FHA loans can go down to 550 credit score. So if you're below that 620 but above 550, you might qualify for that FHA loan, and their minimum is 3.5% down for a first-time home buyer. They're pretty similar to a conventional loan. They do have stricter appraisal requirements. I mean, you have to have a handrail for any step you have, and if you have chip paint for conventional, we don't care. Chip paint on FHA, you're going to have to scrape that and repaint it. But besides that, they're pretty similar. All right, other terms you might hear when talking: your length or the term of your mortgage. Normally, especially for first-time home buyers, 30 years is what we do. 30 years is the maximum. If you can do a lower term, like a 15, 20 year, but we want to usually set you up with the lowest payment possible. The interest rate's not that much different, and you can always pay more during your loan, and anything you do above and beyond your normal payment will go to your principal amount. So what's your components that make up your complete payment? PITIA is what we call it. So P is for principal. That's the amount we loan you. That's what you're paying on. I is interest. That's the interest rate that we're charging you. That's the payment that you're coming to pay the interest rate. T is for taxes. You're going to have those. And just so you know, taxes usually go up about every year. Every once in a while they'll stay flat, but usually they go up, which means if you're escrowing, and we'll talk about that, it means your escrow payment, your payment's probably going to go up a little bit every year. I is insurance. It's mandatory. Homeowners insurance, you have to have it. If you're in a floodplain, there's flood insurance, and you have to have that too. Your realtor will be able to help you out, tell you if it's in a floodplain or not, or we can too. And A is for association. Most places association is with condos. You pay an association fee. They mow your lawn, shovel your sidewalks, but some neighborhoods do have association fees too. You're going to want to make sure you find out if that's part of it, because that's a payment that you're going to have every month. So you heard me talk about mortgage insurance before. And like I said, if you put less than 20% down, or if you're at 80% or above, you're going to have mortgage insurance. Mortgage insurance is not like homeowners insurance. It pretty much does nothing for you, just to be honest. It protects us, the lender. So if you don't pay and you get foreclosed on, it helps pay the loan down. It's mandatory on every mortgage that you have over 80%. But yeah, you want to get out of mortgage insurance as soon as you can. The good news is, like I mentioned before, you're paying down on an asset that's appreciating. For myself, I can remember my first house. I think I put 5% down, and after 2 years, I'd paid enough and my house appreciated enough, I was able to refinance and get rid of mortgage insurance. So that's something that a lot of you will look at if you're not able to put that 20% down. Otherwise, if you just keep paying it, once you get to 78%, it immediately drops off. Our goal is to get you there as soon as possible, so you can get rid of that. All right, so now you know some of the terminology. You're going, okay, I want to buy a house. Well, how much can I afford? That's the question, right? You don't really know. But let's say you're looking through it, you talk to a loan officer that helps you out, and they go, okay, $150,000 house on a 30-year term, 6.5%, putting 5% down, so you're 95% loan to value. Your principal and interest would be $950. Your taxes and insurance would be approximately $300, and your mortgage insurance would be $80. So that'd be a total payment of $1,330 if you're buying a $150,000 house. So what I tell people is find that out in advance and then see if you can make that payment for 6 months. So let's say your rent's $1,000 a month, and you say, okay, but I'm going to make $1,330 a month, so I know I can afford this payment. So you put $1,000 towards rent, and you put $330 in a savings account for 6 months. And at that end of 6 months, you I either have the knowledge or that I feel good that I can afford that payment, or maybe I found out I can't. I've got to redo some things. And then on top of that, when you're done, you feel good that you can afford that payment, but you also have $2,000 now saved to go towards closing costs or down payment. And if you might know within 2 months, I can't afford that payment. Or you might also think, I can actually afford more. Maybe I can afford a bigger house and feel comfortable with. So us as lenders, what do we look at for you guys for approval? Number one is income and employment. And it's not just where you employed at and how much do you make, it's can we count it? If you get paid cash, that's awesome. You're not paying taxes on that. We can't count it. If you own your own business, but you don't show any income on your taxes, fortunately, we can't count it. If you have a second job and you've been there less than 2 years, we can't count it. So it's things like that we look at and we can walk you through. Then we look at what other debts do you have? Student loans, credit cards. What's your debt to income ratio like we talked before? We usually like to keep it at 40 or 43% or below. How much are you going to put down? So if you have that mortgage insurance. Cash available after closing. Do you have reserves? Let's be honest for a second. Most first-time home buyers aren't going to have reserves. You're using that for a down payment. But if you do, it can only help. What type of mortgage product? Do you want to do a fixed? Do you want to do conventional? Do you want to do government? What's the interest rate going to be? What's the length of the term? And then again, credit history. And Rachel did a great job talking about credit before, and you saw with Debbie too. If you're not where you want to be right now and you can't get approved, that's okay. We can help you with a financial coach. Send you the green path, and if you put in the time, we can help you out with your credit. But what credit's going to get you, it's going to get you approved, it's going to get you a better rate, and it's going to get you, even on your mortgage insurance, if you have it, it's going to get you lower mortgage insurance because you have that good credit. So credit is very important, and like I said, not everyone's there now, but we can help out with that. So your next thing when you look at a house is you got to get pre-qualified. If you go to a realtor and say, I want to look at a house, the first thing they're going to say, are you pre-qualified? Because if you're not, I'm not going to show you the house. And we've had some things change with who pays for the realtor, but still 90% of the time, the seller's still going to pay for the realtor. So you can negotiate where the realtor is free for you. And what's a realtor going to do for you? They're going to show you the houses. They're going to set up all the houses to show you. There's a lot of paperwork you don't know about that they're going to handle. But 3 is they're going to help you through the process. And I use myself as an example. The first house I bought, I remember looking at it. The house was probably 40, 45 years old. We're in the basement, and the realtor says, this basement's pretty nice. I'm like, yeah, it's about 2-3 years old. He's like, exactly. What happened around here 2 to 3 years ago? And I went, oh, Duck Creek flooded. He said, exactly. And it didn't mean I didn't have to buy the house. I mean, I could definitely, but it helped me and it gave me knowledge to make the best decision possible, and that's what a realtor is going to do to help you out. Okay, so what do we look at? What do we need from you? You think you found the house. What do you need from, what are we going to ask for you guys? And it's going to be 2 years tax returns. And we might not need all of this, but have it ready. 2 years tax returns, 2 years W-2s, 30 days worth of pay stubs, your insurance agent, who you're going to do your insurance through, and the last 2 months of bank statements. You're also going to want to be able to explain some irregularities if you've had them, and we call them, they call them letters of explanation. Your credit. Listen, if you have slow credit or your credit score is not as high as it should be, you've had some slow pays, it's okay. We can still do the loan, but you got to be ready to explain that. And just a letter that says, I don't know, I just got behind, we don't like that. The more informative you can be, the better it's going to help us out. We get that life happens. Explain it. Job. Once again, if you are on a new job, that doesn't mean we can't do the loan. If you've had some gaps in your job history, once again, it doesn't necessarily mean we can't do the loan, but be able to explain them. We've had people say, my wife was sick, so I took 2 or 3 months off. Be able to explain it. It helps. We're asking you to help you out during the process. All right, so you found a house. That's awesome. Now what gets involved? That seems like it's the easiest part. Now it gets real. So what we're going to do is we're going to send you out a loan estimate. And the loan estimate is going to say all the fees that are charged in this loan. So that way you can look at it and understand. If you're looking at a couple different places, you can compare loan estimates to see who has the lowest closing costs, interest rate. Because people might come to you and say, hey, we have the lowest interest rate. It might happen, but it's because they're charging the most in points and fees that go along that. So you want to look at that and you should at any time be able to go to your loan officer and ask those questions. And we'll send this out within 3 days of your application, or 3 days of receiving your purchase agreement, and that's when your application starts. So during the process, you'll give us the information, and then you'll get communication back from us saying, hey, you're approved. When can you close? That happens rare. Truthfully, it's usually like you're approved. We need a couple more items from you to get that. A lot of times they'll come back, we'll look at it and say, maybe we need that letter of explanation. Maybe we need another pay stub. But we get those, then we're approved. And there are times when we say, hey, we can't do anything, you're declined. I will say this, it is very rare to get all the way here and for us to decline someone. A reason might be if you told us you make $10,000 a month and your pay stub comes at $5,000, that's an issue. But for the most part, it's very, very rare we get to this stage and we decline somebody. There might be some contingencies you write on your contract, and then with your realtor, and they might say, hey, I want to fix the roof. I want to get a radon and make sure that if it's not been taken care of, that gets mitigated. And that's great, and you should do that. Just know this, if it's on the purchase agreement and we see it, it's got to be taken care of. And I say that because we get a lot of times people say, I want to get the door fixed. It's a contingency. I need this step on the backyard fixed. If it's not done and it's on the purchase agreement, we're going to make sure it gets done. And they'll come back, a new buyer will say, well, I don't care about that. And unfortunately, if it's on the purchase agreement and we see it, it's got to be taken care of. So if you want to do it, great, but just understand it's got to get done. All right, so now you've been approved. We're getting ready for the closing. First thing I'll tell you, well, before closing, maybe before approval, this is my last step here, is get your home insurance right away. That's usually one of the last things when I've looked at thousands and thousands of deals. It seems like we're all approved. We just need the homeowner's insurance. And going back and forth and getting that is not always the easiest. So the sooner you can do that, the sooner we can get your loan cleared to close. Just so you know, we do have our own insurance company here at IH. So if you don't have one, we can give you estimates. If you have one and like to compare, we can do that. On average, our members save around $600 yearly with us on their auto and home insurance. So if you want to get an insurance quote, we'd be more than happy to get that for you. They do a great job, so we can give you more information on that too. Okay, so now you're approved. What we're going to do now, before approval, is we're going to send you, we sent you that initial disclosure that gave you the loan estimate. Now we're going to send you a final one saying this is what your final closing costs are going to be, and you can compare them and see, did we say what it was going to be? If we're off, you need to ask us. And we're going to send this to you 3 days before closing, which is nice. About 10 years ago, it used to get this on the day of closing. Can you imagine? Like right at closing, you look at that. Now you get it 3 days beforehand, so you can look at it. If something doesn't make sense or you have questions, call us, because you're going to have to sign off saying that you got it and you understand it. We should be able to answer any questions that are on that. Then you can also set up your own closing attorney. That's the one thing you get to choose. Your appraiser, you don't get to choose your appraisal. Who we do the credit report with, we decide. Closing attorney, you get to choose. Most people don't know one. We have ones that we work with that are very good that we can let you know. But if you have one that decide, you get to choose them. We just make sure that they're a closing attorney. All right, so you're approved, you're closed. What are some things to think of? Your mortgage payment. You want to confirm what the amount's going to be, when the due date is. I'll save you a surprise. The due date's always the first for mortgages, the first of every month. And then what way are you going to pay it? Do you want to set up a direct deposit to pay it? Do you want to set up online? Are you just going to do it online? Or are you going to send in a check? Know about that. So when it comes time, if we ever have first payments default on the mortgages, it's just because the payment wasn't set up the correct way. We can help you out with that. And then know if there's any other fees. Like I said, the association. If you have association fees that you're going to have to pay, know that, because those come up during different times of the year. And then principal payments, like I said, if you want to make more, anything you pay above and beyond your normal payment will go to principal. If you decide, or you get an increase in your income and you want to do that. And then you might hear this, transferring of servicing. So what does servicing mean? So if we service your loan, it means you make your payments to us. It says IH on the credit report. If you have a question, you come into our branches and you ask a question, or you can pay in the branch. If you don't make a payment, we're going to be the ones that call you. That's what servicing is. So if you do a loan where we don't handle the servicing, like I said, we probably handle servicing on 95% of our loans. But there are people where we say, hey, we can give you this rate, let's say 6.5%, and we'll service it, or we can give you 6.25, but someone else is going to be servicing it. Some people are like, I want you to service it, and others are like, I don't care, I want the lowest payment. What can happen is, the good news is your interest rate, your payment, everything about your mortgage cannot change if someone else services it or if they sell the servicing to somebody else. The only thing that can change is who you make your payment out to each month. So that's another part of it. And you'll learn that in the beginning with your loan officer. Do you want us to service it, or do you want maybe a lower rate and someone else to? We mentioned the escrow account before. That's where we pay your taxes and insurances for you. If your loan to value is over 80%, it's mandatory. We will escrow for you. Once you get to 80%, you can choose and you can say, hey, I want to handle that myself, or you can still have us handle that. I always have the financial institution handle my escrow. I don't want to have to worry about making those payments. In Iowa, it's every March and September, and then your insurance throughout the year. In Illinois, I believe it's 4 different times throughout the year. It's up to you. After that, if you want to do it, you can. Otherwise, we're able to handle that for you, and there's no cost to it. Once again, like I mentioned before, for your taxes and your interest rate, you can take your interest and the taxes that you pay on it, and they can be deducted in a lot of cases, but I am not a tax advisor. We'll send you a 1098 form to show you how much interest you paid. Take that to your tax advisor to see about writing those off on your taxes. And then lastly, if you can, try to have a cushion over time if a financial emergency comes up. Those furnaces and air conditionings don't last forever. Same thing with refrigerators and dishwashers, in case something like that happens. But let's say it's bigger. Let's say something happens major in your life and you might not be able to make your payment on time with us. A lot of people say, I'm just not going to answer the phone. I don't want to deal with it. But if you call us and you take our call and we can help you out in that situation. And the sooner you do, the better. The longer it goes and affects your credit, the harder it gets. We have programs that can help you out. And I can tell you this, I've been here for 16 years. The last thing I ever want to do is take someone's house. I pride ourselves, we have very few foreclosures because we work with people, but you've got to answer that phone or give us a call when that happens. Life happens, we understand it, and we're here to help you out. All right, our next presenter will be talking about the fun stuff, and that's the down payment assistance programs that can help give you money to help out with closing costs. And we have Tasha Bunker, our loan originator here in the headquarters to talk about that. Tasha?
Good evening. My name is Tasha Bunker. I'm a mortgage originator here for IH Mississippi Valley Credit Union. I've been with the company for 19 years now, helping members achieve their financial goals. And probably helping them purchase their first home is one of the most rewarding aspects of my job. I get a lot of questions on what are the benefits or what's out there for me as a first-time home buyer. And one of the biggest benefits are the down payment assistance programs. We use several different programs here at the credit union, and I've even used them outside of the Quad City area, so if you're looking somewhere else, I'll be happy to hunt one down for you. We're going to talk about tonight the Iowa Finance Authority First Home Plus program, their Homes for Iowan program. We're also going to talk about the Down Payment Plus program, and then we're going to have some guest speakers present the City of Moline and the Economic Growth Corporation for Rock Island. And if you're looking to purchase a property in Iowa, we're going to use Iowa Finance Authority to help you secure some funds for down payment and closing costs. When we're looking at your application for pre-approval, part of the process is to take a look to see what can we do to take advantage of some free funds out there. You may not necessarily need them, but it's nice to know that these options are out there for you. As Kurt has told you, you're going to want to make sure you have savings and being ready financially to purchase. You're going to want to have your credit in order. And these items are also going to be extremely important in ensuring that you can qualify using one of our down payment assistance programs. Some people believe you can walk in and not have a down payment. You don't need to have funds. These programs will take care of everything for you. But in fact, they won't. They're going to supplement what you already have, maybe allow you to retain your personal finances so you can have that nest egg for a new fence, some furniture. Maybe you need to do some upgrades to the house. Maybe you just need to have a savings account. So if you're looking in Iowa, you're going to have an option to utilize the Iowa Finance Authority's two programs. Homes for Iowans is geared for home buyers with a higher income limit. The income limit is going to be above $96,500, but it's going to cap out at $163,800. So if your income is exceeding that, we're not going to be able to qualify, unfortunately. But if you do fall into that bracket, you can utilize this program to enhance your down payment, maybe cover your closing costs. You can get up to 5% of your purchase price limit or a maximum of $5,000. This is going to act as a second mortgage on your home. When you purchase a house, your primary mortgage is going to be in first position. This product is going to be in second position. It does not, or it's not forgiven. It is going to remain there until you either refinance and pay it off or sell the house and pay it off. There's no interest on this product, but you do need to repay it back. Homes for Iowan is also available if you are a repeat home buyer. So this particular program is the only program that IFA, or Iowa Finance Authority, offers that you can utilize as a current homeowner. The credit score, though, this is where maintaining your credit and ensuring your credit is in a good place when you buy a house is important. You have to have a minimum credit score of 640, and your debt ratio cannot be over 50%. Ideally, we want to keep you between that 40 to 43%, but 50% is the max for this program. That's something we'll do with some coaching and discussing. Is this really smart for you? Maybe, of a big, raise coming up down the road that you're like, no, I'm okay. But honestly, keeping your debt ratio below around that 40 to 43 is a lot better. But with this, we can go up to 50. If your income is below the $96,500, we can utilize their First Home Plus program. This is going to act in the same manner as the Homes for Iowan. It's going to be a second mortgage on your deed. It can go up to 5% of the purchase price of your house. This has a maximum of $10,000. The income limit, $96,500 for a household of two, or $110,975 for a household of three or more. The purchase price limit, we're looking at $624,000 in Scott County, but this program can be used in any county in Iowa. The first-time homebuyer program, you do need to be a first-time homebuyer, or you need to be buying in a targeted area. Those targeted areas are several different neighborhoods that we have in Scott County, and if you're interested in buying a house in those neighborhoods, we can pull it up and see if that complies with your program. Same as the Homes for Iowan, we need a 640 credit score to obtain approval for this. One of the requirements for this program is an online home buying course they offer through their website. I've heard it takes about 45 minutes to complete. You'll get a certificate once that's completed and pass that along to me. Otherwise, we'll calculate your income, and that is all it takes to get this program. When we're using that 5%, it can cover closing costs, and it can cover your down payment. As a first-time home buyer, you can put 3% down if credit is strong enough. Therefore, we would have a remaining 2%. We can supplement and pay some of those closing costs. I would highly recommend, when you're getting pre-approved, to have your savings set and ready. So when we're adding these programs on, again, it's a supplement to what you already have. You're not relying on this to purchase. One of my favorite programs we offer is the Federal Home Loan Bank program. This is also called the DPP, the Down Payment Plus program. It is a forgivable second. So this is more acting like a grant that is forgiven over the course of 5 years. When you purchase a home, you can utilize this program, which goes up to $10,000 to cover your down payment and your closing costs. But the added advantage of this program is every single month over the course of 5 years, a portion of that amount is forgiven. So we're going to see when you refinance or if you sell within that 5 years, a lesser amount needing to be repaid. That's more equity for you that you're gaining while you're utilizing this program. This program does have a few extra requirements than Iowa Finance Authority. It's going to require an online home buying course. Once that's completed, you have to do a one-on-one course with a counselor. I'd be happy to pair you up with a counselor that can help you with that. Once you've completed those 2 items, you get course certificates. Those are provided to the Federal Home Loan Bank to show them that you have completed this step. This program, though, does not have a minimum credit score, so if you qualify for a loan under 620 or 640 or even 580, you can still utilize this program as long as we're getting approval for FHA or conventional financing. The income limit, though, is the biggest catch-all on this one. Most people are limited on their use of this program by meeting the income limits. For this program, we're going to follow the HUD income limits. It is a sliding scale depending on how many members are in your household. Members of household are your dependents included, or even a family member living with you. Anyone over the age of 18 working, their income has to be calculated into that outside of the application, whether they're on it or not. We're still going to have to calculate their income. For a family of 1, so if you're just a single person buying your first house, your maximum income limit is $54,750, upwards to a household of 8, which is $103,200. This program does require you to have some money into the program, or into the transaction. It needs to be at least $1,000. This can include your inspection fees. So if you're getting a house inspection, a pest inspection, you put earnest money down of maybe $500 to $1,000. That's going to satisfy this requirement. That is money that you've invested in purchasing this house, and they're going to count that. But you have to have a minimum of $1,000. I caution you not to just have $1,000 and apply for this program, because most likely you're going to need a little bit more depending on the price point that you're looking at and the down payment requirement that's going to be needed, or what your closing costs are, or how you negotiate who's paying closing costs. As I mentioned, though, this is a forgivable loan, so we will be able to provide you with information as throughout the course of that 5 years, how much is still left and how much you owe on that, if you are thinking about refinancing and or selling your home. And with that, I will give you over to KJ from the City of Moline. She'll discuss the programs that they offer.
My name is KJ Whitley. I'm with the City of Moline. I am the Community Development Manager. I've been there 24 years now. So I've been involved in housing programs since 2009. Up until that time, I'll tell you my dream, because it's everyone's dream to own their own house. I was living in a duplex for 17 years, and I had some neighbors that moved in that were doing some illegal substance. So it was coming up through the vents. And I said, I can't live in this house. I work for the government. I can't go into work smelling like marijuana. So I picked up the phone, called a bank. I said, hey, can I get a loan? Didn't know anything about the process. And they called me back about an hour later and said, well, how much you want? I said, don't give me too much. I'm not that responsible. So then I got funded, and then it was a search for a house. And in my mind, this is my first house. I wanted the biggest house, the best house. I wanted to show it off. And I probably looked at 10 houses, and I went back to the first one I looked at and bought that one. But I mean, it's a great feeling to own your own house. I remember after the closing, we got the keys, and I just went to the house and I rode around on the living room floor. And I'm just like, hey, I can paint that wall green and that wall purple if I want to. But then came to the fun part. Time to move in. You'll never realize how much stuff you have until you have to move. So just keep that in mind. So with our program, we offer up to $7,100 for down payment and closing costs. Right now it's $7,100. I do have a proposal that's probably going to go to our city council probably in the next 60 days, where I would like to raise that amount to $10,000. But council has to approve that, and then I send it up to HUD. So let's talk about HUD. So yes, this program is funded through HUD. which is a good thing. We have this program since 2019 now. We do have we do have HUD dollars available, despite what you might be hearing out there in the public. It's a program that we're funding every year, that we're getting our allocation. And this year will be our 51st year of receiving HUD funds in the city of Moline. So hopefully that continues under the current administration. We're going to move forward like it is going to continue until they tell us it's not continuing. So it's a program that we anticipate funding every year. We do have funds available right now, but again, those funds are at up to $7,100. So in order to be eligible for our program, it is based on income. Again, it's the same income limits that they were just going over. So for one person, you can make up to $54,750. And these numbers just went up about 2 weeks ago. And so for a family of 4, you can make up to $78,150. So that went up about $7,500 since last year. So they can go up, they can go down, but right now the trend is that number keeps increasing. So that's your gross amount. That's not after taxes, it's your gross amount that you're making, and that's how we do our calculations. And this is a program for first-time home buyers. And how we calculate a first-time home buyer is you haven't purchased a house in the last 3 years. So that would make you a first-time home buyer. We do require that you take a home buyer class, but with ours, you cannot take the one online. We want you to spend a Saturday with James, who's going to be our closer today, over at Growth, and he'll talk about that, and you'll get a home buyer's certificate. And then for our program, you also have to put $1,000 towards the purchase of the home, and that can be done with your prepaids or your earnest money. So you got to get your certificate, you got to put $1,000 towards the purchase, and with our program you have to work with a realtor or attorney. We don't allow you to buy the house on your own. One of the advantages of working with a realtor or attorney is that they have the education to pass on to you. We want you to know what you're getting yourself into for the next 30 years, so there's no hidden surprises. We also require what's known, it used to be called a housing quality inspection, but now we call it an Inspire, where basically we're going out looking at making sure you got running water, no holes in the roof, smoke detectors. That's a big thing that we catch before we would go to the closing and provide these dollars for you. So that is one requirement. So again, you got to take the class, you got to work with the realtor or attorney, you got to put $1,000 into it, you have to be a first-time home buyer. But let's talk about the debt ratios. So on your front end, it cannot be any more than 31, and on your back end, it cannot be any more than 43. That is what it is today. We are discussing that at the staff level with our membership board, so that might increase, because the trend right now is to have that back number increase. So we'll see what they say on that, but right now your front end, without your house payment in there, cannot be more than 31% of your gross income, and on the back end it cannot be any more than 43% of your income. How do you apply? Well, the City of Moline, for our housing programs, we have moved everything online. So if you don't see it online, certainly give us a call and we'll email you out the application and the process. There's certain documents that we're going to need from you to determine your pre-approval. It takes us about 30 to 45 days, just like with the bank, to go from A to Z on your closing, because there are things that we have to do as well as that the bank has to do. But if we can close it in 30 days, we will. But on average, it's probably about 37 days, to be honest with you. We have funds available, so please go to our website or please give me a call. We would like to help you guys.
Thank you, KJ. Up next, we have James Jones from the City of Rock Island, and he'll be talking about all the great programs they offer. James?
Hey, everyone. All right. So first, I always like to, first off, I just want to acknowledge IHMVCU Valley for putting this nice event together. I have to say, it just gets larger and larger every time I'm looking into this crowd. There's like a sea of people here now, but let's give them a praise offering. We appreciate this. And then at the same time, we appreciate you. Whether you know it or not, you are actually on your path to home ownership. You're putting together a team. You're putting together a team of professionals that you are trusting. For a lot of us, your most expensive purchase you're going to make in a lifetime. So you're wanting to talk to a lender who is interested in your financial goals. You're going to talk to a realtor if you choose to use one to help you in the home buying process. And throughout that, you're going to go across a lot of professionals that you normally would not come in contact with, your appraiser, your inspectors, people like that. But at the end of the day, even though we're putting together a team, we can't negate the fact that we wouldn't be here without you. You are always the star of the show. And with that being said, that's why so much effort and time is put into the path of home ownership, because there's a lot of questions to that, and we realize that, so I wouldn't be doing my job if I didn't mention that, because that is very important, and that's why we prepare, all the way up until the closing. You're in a point where you're preparing for home ownership, you know what I mean? So who's at the very beginning stages, by show of hands? Like, I'm just starting out, okay? I'm in a room full of experienced people in here, and that's okay. I just got to step my game up a little bit. Who's, maybe kind of in the middle, the middle of the transaction, show of hands. And who's in, like, I don't know where the heck stage I'm in, but I'm in it, I'm in it. I'm going to get to the end, and that's okay, because we're going to be here for you every step of the way. And thank you for sharing me a little information about you. Let me bounce the equation and share some information about me. You said up and down, right? Here we go. You got me?
Just this.
Okay, there we go. Economic growth, we've been around since 1983, and as a housing manager, my responsibilities gravitate around the steps of home ownership. Whether it's pre-purchase, there's certain steps and ideas I like to discuss to get people prepared for becoming a homeowner. There's information and education sometimes that you might have to be required that some of the presenters mentioned. You might have to talk to a HUD-approved housing counseling agent or a housing counselor, and that's me. That's why I come in. I am HUD-approved, and I go through the necessary information that is needed to teach homeowners to be successful. And that's what we want you to do. We want you to be successful, and we understand that there's a lot of moving parts when it comes to becoming a homeowner. And I like the slide when we were talking about down payment assistance, and I've seen the puzzle and everything like that, and I really relate to that, because at the end of the day, it's like we're putting together a puzzle. Some of the pieces we kind of have together. Some of these pieces are kind of crazy. I might have to work on that to kind of fit it within my puzzle, and that's okay, because it all relies on who we are as a person. So I always like to say, even if it isn't your first step, even if we're towards the end, whatever it is, know who you are when it comes to budgeting. Know who you are when it comes to credit. Know who you are when it comes to different financial maneuvers. And the reason why I say that is, am I to be trusted on payday? Because I don't know about you, I'm always in a good mood on the 15th and the 30th. I'm feeling good. And the day after, I wake up with my clothes torn, like, who was I last night? Maybe I should have put my paycheck back for a few hours until I, start spending my money. Then, all jokes aside, at the end of the day, it is very important to find out who you are when it comes to money, and that just helps you down the path of home ownership. And then, as it relates to how are you handling your credit, is there something I need to work on? And if so, Kurt shared good information. He has a team of lenders that's there to help you get to the finish line, and credit for a lot of us is going to be a very important aspect. Well, for all of us, a very important aspect as it relates to home ownership. Okay, so let me get out my soapbox. I get going sometimes here, but we've been around since 1983. We are a national nonprofit. We are community-based, but we do have a regional focus, meaning that we are based here in the Quad Cities, but we also have other service areas throughout the nation that we also help out when it comes to home ownership. Then also home buyer education. That is one of the most important elements I want to say that I do as a HUD-approved housing counselor, okay? So housing counseling is for anybody, whether you're a homeowner, whether you're a renter. I do do appreciate my partners here at IH Mississippi Valley also offering information to help you keep your home. And I generally tell people that, work with me, there's a lot of signs that go down before you even get to that point of, let's say, missing your house payment. And that kind of goes back to the basics, the things that we're talking about: budgeting, credit, making sure that I have enough money set aside for emergencies. We all went through something very devastating. And I'm not going to start talking about the pandemic, but one thing we learned about that is if I'm budgeting and I know what my expenses are, well, it makes sense for me to save 3 to 6 months of my expenses. And then if I notice I'm not able to save it, then I need to maybe look and see why I'm not able to do that. And I call those my red flags, my warning signs before we kind of get to that position where we're missing a payment or anything. But again, so what's available at your housing counseling agency? Like I said, pre-purchase home ownership. Anybody wanted to know what to do after you become a homeowner, I also teach a post-purchase class that talks about different financial strategies that are put in place to make you a successful homeowner. All right. Now, I'm here to talk about my down payment program as well. We sponsor a Live, Work, Rock Island program. This is for anyone that's looking to buy a house in Rock Island. You can receive up to 5% of the purchase price plus $1,500 in closing costs. You can earn up to 120% area median income. So it's a very generous program. And for an example, if you see a home that is $100,000, with this program you would receive up to $6,500 in closing costs and down payment assistance. And it works just like the other down payment assistance programs that were shared with us this evening. 5-year recapture, stay in the house for 5 years. You don't have to repay back any of the down payment assistance. It is prorated. Life happens. If you moved prior to that time elapsed, it will go down accordingly. Okay. We also have a Moline down payment assistance program. It's a little bit different. It's very similar to the Live, Work, Rock Island, but the only difference is it's only offered in certain census tracts. I have to say we have finally closed on a few participants with the Live, Work, Moline program. Should you have any questions with that, definitely reach out to me. It is a few extra moving parts to it, but it's all address related as it relates to the census tracts, I should say. So if you just give me an address or home that you might be interested in, I can look it up in a few minutes to let you know if it is eligible for this program. And it's similar as far as you can receive up to 5% of the home's price and down payment assistance plus $1,500 in closing costs as well. 5-year recapture. And I also I'm involved when it comes to the Federal Home Loan Bank Grant too. Whenever I get a call from the lenders here at IH Mississippi Valley, they let me know that they have someone participating in that program. We can set up an appointment, and after we meet, I'll be able to provide you with a home buyer certificate that makes you eligible for that particular program. Okay? So if you have any questions about any of these programs, please feel free to reach out to me. A lot of the members here that work for IH Mississippi Valley, they're familiar with some of the programs I offer as well. So ask them, and if they can't answer your question, they will get in contact with me. Again, I know this is a journey. It might seem daunting at times. I get it. The housing market is competitive, but we can't control the housing market. At the end of the day, we can't. But one thing we can control is our financial position. And what am I talking about? Am I using a budget right now? Do I know what my debt to income ratio is? How's my credit look? Those are the things that we can control to make a smooth transaction and a smooth path to home ownership. So those are the things that we want to work on, or kind of pregame, so to speak, and the things that we have control of. So definitely ask your lender, that you're working with here, how can you be on the smooth path to home ownership? And I'm sure that they will put you there. So that's all I have. Thank you, everyone. Oh, do we got a question?
Can you talk a little bit about your class?
Sure. I left out the class. Yes, that's right. Thank you, KJ. I was trying to get out of here, right? I do host a home buyer class once a month, and I guess I'm kind of ashamed to say it a little bit, after I listen to Kurt up here and just kind of run everything down in the conversation. My class is from 8:30 to 2, but I promise I do keep it interesting. I tell a few bad jokes, but the main thing is that you get all the information that you need to ensure that you have the confidence, or maybe even ask questions. I have to say that that's probably one of the biggest elements on the home buying journey is asking the questions. You know, we don't expect you all to know everything, you know, right off the bat, but when you get information, that kind of gets your mind thinking, get going, and I know someone's listening to me usually when they ask questions, you know, so there's nothing wrong with that. I do have a schedule that's available on my website, economicgrowthcorporation.com. Should you have any questions too, reach out to me and I can email you that schedule. It's once a month. It's usually around in the middle, just kind of depending on what's kind of going on for that month. 8:30 to about 2 p.m. You will get a HUD approved housing counseling certificate by attending my class. It's good for a year. So if you're kind of, you know, going through the home buying process, you know, we don't want to put a lot of pressure on you. So it does give you a little time to use that certificate before it does require you to get it renewed. And, you know, I'm pretty flexible. If you're like a month or so over, just give me a call. We can go over the changes, and then that way we can kind of get you on the right track, you know. So a lot of changes going on in the market, you know, that Kurt shared with us. But again, we control our destiny by by being prepared. I should say it like that. You want to ask as many questions as you can, and then make sure that you're on the right path. I can say it like that. So thanks, KJ. I was about to leave the class out. All right, I got a question. Hey.
I have 2 questions.
All right.
First one is, are you guys similar to them, like where you'll once a year, just anybody who's satisfied their lien, will you automatically release it? Like do like a recapture, like will you, like then they're doing it once a year, or does someone have to reach out to you to say, hey, I'm moving, I've satisfied this time, take your lien off? So it does that.
Wow, this put me on the spot here. You know, let's work together. I just said some, you know, and I don't want to mislead you, because you know what, sometimes there are times when a recapture might reach the expiration date and we might not even know about it, because I go through that almost on a daily basis as far as like the different programs that might have existed before I got there. I do my best. I do my due diligence to kind of remind people that, hey, you got a recapture coming up. So I say that, you know, we work together when it comes to time for that. You know, that's a good question. Yes.
I have something to add to that.
Okay.
We had a title that had your lien on it, and you guys released it immediately.
Oh yeah, oh yeah. James Jones don't mess around. We'll get it done. Thank you. I was kind of struggling there, but okay.
You bring the papers down.
Bring the papers down. Yep. Right, and we get it. And you know, think about it. It's like top of mind awareness. You know, you're excited. You got your home. You know, 5, 6, 7 years go by. I get it. That's the last thing you're thinking about probably is that recapture until that time comes. The refinance, sell. So I get it. You know, but we definitely will work with you to make sure we get that release for you, because you know, I guess it's not important until it is.
No. I feel like I just told you were like, sure.
Oh yeah. Oh yeah.
But my second part to this is when I did the economic growth program about 16 years ago, I also got rehab money.
Yes.
You still offer that?
Ooh, you know, life was good back then. Yes, life was good. Yes. We had, you know, there's a lot of programs. There's a lot of available money out there, you know, but I don't want to be Mr. Jones the Downer here. You know, we all know what's going on, but let's hope that some of those programs do come back, because that single family rehab program, huge program, and that was through all of Rock Island County to help people if they had some unsafe conditions in their home. We could get them approved for, at that time, I believe it was up to like $45,000. Yes. That's like windows, sidings, you know. And again, it's unsafe conditions. We're not doing grottos or swimming pools or anything like that, you know. Although that's nice, you know, it's nice. But unfortunately, the program isn't that. And another one that I missed was the home ownership accessibility program. And that was designed for our neighbors that might have situations to improve their living situation, you know what I mean? Maybe make some wider hallways, wheelchair accessible, really depending on whatever the applicant needed. And that provided up to $25,000 in aid. So we definitely want those programs back. The Illinois Housing Development Authority sponsored those programs, and we're lobbying for them. Don't think that they're going away and we're not saying anything, but we are still trying for our community, because community revitalization is important for everybody. When we buy a house, and let's say a house is in our neighborhood and needs to be improved, that's what that program is for, because that helps with your equity. You want the houses in your neighborhood to be fixed up and looking good because that helps everybody. Absolutely. Great questions. Thank you. In just a moment, I thought I was going to be in trouble here. I'm okay. Good stuff. Good stuff. But I have to say, I'm proud of all of you. I'm proud of all of you that you spent some time on a nice evening to talk about and share ideas about home ownership, and that I have to say that, yeah, you guys should all be proud of yourself. I'm proud of you, so I hope all of you are homeowners very soon. Yes. All right, let me get out of here before they kick me out of here, all right?